Welcome back to the Deep Dive. Today we're diving headfirst into the world of the UTI Nifty 50 Index Fund and helping you understand if it deserves a spot in your portfolio.
And we've got the perfect guide to help us navigate this exciting corner of the market.
Oh yeah, who's the Sherpa on this expedition?
None other than SOS Finwell. They've put together a report that's basically a crash course on this specific fund.
I'm always up for expanding my investing knowledge, especially when it comes to something as interesting as Indian equities.
And that's precisely who SOS Finwell had in mind when they created this report. They know there's a growing interest in investing in India's potential.
So are we talking about seasoned investors, or is this more for someone just dipping their toes into the world of investing?
It's really geared towards making investing approachable for everyone, but it's especially valuable for those who are new to the game or maybe a little intimidated by the complexities of the stock market.
I like it. Demystifying investing. That's what we're all about here too.
Absolutely. SOS Finwell wants to empower you to make informed decisions about your money, and this report on the UTI Nifty 50 Index Fund is a perfect example of how they do just that.
Okay, so before we get into the nitty-gritty, let's zoom out for a second. What's the big picture here? Why should our listeners care about this particular fund?
In a nutshell, this fund offers a way to tap into the growth potential of the Indian economy without having to pick and choose individual stocks.
Intriguing. So it's like a shortcut to diversifying your portfolio with some of India's biggest companies.
You got it. Instead of putting all your eggs in one basket, you're essentially investing in a basket of 50 of India's most prominent companies.
Okay, that's starting to paint a clearer picture, but let's break it down even further. What exactly is the UTI Nifty 50 Index Fund and what makes it tick?
At its core, it's an index fund, which means it's designed to mirror the performance of a specific market index, in this case, the Nifty 50.
The Nifty 50. I've heard that name thrown around, but I'll admit I'm not entirely sure what it represents.
No worries, it's actually pretty straightforward. The Nifty 50 is an index that tracks the performance of the top 50 companies listed on the National Stock Exchange of India. Think of it like a benchmark for the Indian stock market.
So when someone says the Nifty 50 is up today, they're basically saying the overall Indian stock market is doing well.
Exactly. It gives you a snapshot of how the big players in the Indian market are performing.
And the UTI Nifty 50 Index Fund tries to match those moves as closely as possible.
Precisely. So instead of you or I trying to pick and choose which of those 50 companies will do well, the fund does the heavy lifting for us by passively tracking the entire index.
That sounds like a pretty hands-off approach to investing, which I imagine is appealing to a lot of people, especially those who are new to this or maybe don't have the time to constantly monitor the market.
You hit the nail on the head. That's one of the biggest advantages of index funds like this one. They're designed for long-term growth with minimal effort required on your part.
Sounds like my kind of investing. But before I go all in, let's talk about the numbers, because at the end of the day, that's what really matters, right?
Absolutely. And the report highlights some interesting figures. Let's start with the one-year return, which sits at an impressive 27.16%.
Whoa, 27.16% in a single year. That's pretty remarkable. Makes you wonder why everyone isn't jumping on this bandwagon, right?
Well, hold your horses for a second, because while that number is definitely eye-catching, we need to consider the bigger picture, and that's where the 5-year key AGR comes in.
Okay, 5-year CAGR. What's that all about, and why is it important in this context?
CAGR stands for compound annual growth rate, and it essentially tells you the average annual return you would have earned if you had invested in the fund 5 years ago. In this case, the 5-year CAGR for the UTI Nifty 50 Index Fund is 13.91%.
13.91%, still respectable, but a noticeable difference from that 27.16% we saw earlier. What's the takeaway here for our listeners?
The key takeaway is that past performance, especially short-term performance, is not always indicative of future results. The market can be volatile, and those impressive short-term gains can sometimes be followed by periods of slower growth or even dips.
So don't get blinded by the shiny numbers. Always look at the long-term trends too.
Exactly. And that's something SOS Finwell emphasizes throughout their report. They want investors to understand that investing in the stock market always comes with a certain level of risk.
And speaking of risk, the report does mention that this particular fund isn't for the faint of heart. It's considered to be on the more volatile side, right?
That's right. They're very upfront about the fact that this fund is best suited for those who are comfortable with a bit of a roller coaster ride when it comes to their investments.
So maybe not the best choice for someone who's close to retirement and needs their money to be super safe and stable.
Exactly. This fund is more geared towards those with a longer investment horizon, ideally at least 3 years, if not more. It's all about having the time to ride out any potential market fluctuations.
Got it. So not a get-rich-quick scheme, more like a plant the seed and watch it grow kind of investment.
Precisely. And speaking of long-term planning, let's talk about fees, because those can really eat into your returns over time.
Oh yeah, fees. I swear they're always lurking in the shadows, just waiting to take a bite out of my profits.
Mhm.
What's the deal with fees for this particular fund?
You'll be happy to hear that the UTI Nifty 50 Index Fund boasts a super low expense ratio of just 0.19%.
Wait, 0.19%. Did I hear that right? Because that sounds shockingly low compared to some of the other funds I've looked into.
You heard right, and that's one of the major perks of index funds in general. They tend to have much lower fees than actively managed funds.
Okay, now you've got my attention.
Mm-mm.
Tell me more about this low fee magic.
It all boils down to the fact that index funds are passively managed. They're simply tracking an index, which means there's no need for a team of expensive analysts to pick and choose stocks.
So less overhead means more money in my pocket. I like the sound of that.
Exactly. And that's something SOS Finwell really drives home in their report. They want investors to understand that even small differences in fees can have a big impact on your returns over the long haul.
Makes sense. Every rupee saved is a rupee earned right.
Yeah.
All right, so we've covered the basics. What exactly is this Nifty 50 fund? Who is it for? And why are the fees so low? Let's take it a step further and dive into the exciting world of this fund's portfolio.
Now we're talking. Let's meet the heavy hitters, the companies that make this fund so intriguing.
So who are the big players in this index fund? Give me the rundown.
Get ready for a who's who of the Indian stock market. We're talking major players across a variety of sectors. You've got your finance giants like HDFC Bank and ICICI Bank.
Those are household names for sure.
Absolutely. And they're major players in India's financial landscape. But it's not just about banking. You've also got IT giants like Infosys and TCS.
Right. They're global now.
Exactly. They've put India on the map in the world of technology. And let's not forget about Reliance Industries, a conglomerate with its hands in everything from energy to telecom to retail.
Reliance is like the 800-pound gorilla in the room. You can't talk about the Indian stock market without mentioning them.
You got that right. And that's the beauty of this index fund. It gives you exposure to all these heavy hitters and more in one neat little package.
Diversification at its finest. So instead of betting on just one or two companies, I'm getting a piece of the whole pie.
Precisely. And that diversification is one of the key selling points of index funds. It helps mitigate risk by spreading your investments across multiple sectors.
So even if one sector takes a hit, my entire portfolio won't go down in flames. That's reassuring.
Exactly. And another thing the report highlights is the sheer size of this fund. We're talking about a massive amount of money under management.
How massive are we talking?
Hold on to your hats because the AUM, or Assets Under Management, for the UTI Nifty 50 Index Fund is a whopping 19,848 crore.
Okay, you definitely got my attention with that number. Break that down for me, though. What does that even mean for the average investor like myself?
Essentially, it's a testament to the fund's popularity and the trust that investors have placed in it. A large AUM like that suggests that a lot of people believe in the fund's strategy and its potential for growth.
So it's kind of like a seal of approval from the investing community.
You could say that. It adds a certain level of credibility and stability to the fund.
Interesting. Now let's shift gears a bit and talk about the target audience for this fund. Because we've mentioned risk a few times already. Who exactly is this fund right for?
SOS Fin. It's very clear about this. This fund is not for the risk-averse. It's designed for investors who are comfortable with market volatility and have a long-term investment horizon of at least 3 years, if not more.
So if you're looking for a quick buck, this isn't the fund for you.
Definitely not. This is more of a slow and steady wins the race kind of investment.
Got it. Patience is key. Now, for our savvy investors out there who might be comparing their options, does the report mention any alternative funds that they should consider?
They do. They specifically highlight the HDFC Index Fund Nifty 50 and the SBI Nifty Index Fund as potential alternatives.
So it's like choosing between different flavors of the same ice cream. They're all Nifty 50 index funds, but with slight variations.
Exactly. Each fund might have a slightly different expense ratio or track the index with a slightly different approach. It's all about doing your research and finding the one that aligns best with your individual needs and preferences.
Comparison shopping for your investments. Now, one last question before we move on. I know we have some international listeners tuning in. Can people who live outside India invest in this fund?
That's a great question, and yes, the report does address that NRIs, or non-resident Indians, are eligible to invest in Indian mutual funds, including the UTI Nifty 50 Index Fund.
That's good news for our global listeners, but I imagine there might be some extra hoops to jump through.
There are a few additional considerations for NRIs, mainly around tax implications and regulations set by the Foreign Exchange Management Act, or FEMA.
So if you're an NRI looking to invest in this fund, definitely do your homework and make sure you understand all the ins and outs.
Absolutely. But that's where SOS FinWell comes in. They don't just throw information at you and call it a day. They're all about providing personalized guidance and support.
So it's like having a financial advisor in your back pocket.
Exactly. And that's what sets them apart. They're committed to making investing accessible and understandable for everyone.
It's like having a financial coach in your corner, cheering you on and making sure you don't trip over the jargon.
Exactly. They break down complex concepts into bite-sized pieces and empower you to take control of your financial well-being.
Now that's what I call financial freedom. So before we wrap up this deep dive, let's bring it all home for our listeners. What's the key takeaway here? What's the one thing you want them to remember about the UTI Nifty 50 Index Fund?
I think the biggest takeaway is that this fund offers a fantastic opportunity to participate in India's growth story without having to become an expert stock picker.
It's like a shortcut to investing in India's future.
Precisely. But remember, every investment comes with its own set of risks and potential rewards. So it's crucial to do your due diligence. Consider your own investment goals and risk tolerance, and decide if this fund aligns with your overall financial strategy.
Investing with intention. I love that.
Mm.
And if our listeners are ready to take that next step and explore this fund further, where can they find more information?
SOS Fin was an excellent resource. They've packed a ton of valuable insights into their report, and they're always happy to answer any questions you might have.
We'll definitely include a link to their website in our show notes, so be sure to check them out.
And as we wrap up this deep dive, I'd like to leave our listeners with something to ponder.
Ooh, I love a good food for thought moment. Hit us with your best shot.
We spent this episode exploring the ins and outs of the UTI Nifty 50 Index Fund. But here's the million-dollar question. How does this particular fund fit into your overall investment strategy? Is it the missing piece of the puzzle or one of many avenues you're exploring?
It's all about finding that perfect mix of investments that will help you reach your financial goals. And on that note, we've reached the end of our deep dive into the UTI Nifty 50 Index Fund.
Don't forget, though, as with all investments, mutual fund investments are subject to market risks. Make sure you read all the scheme-related documents carefully before making any decisions.
Knowledge is power.
Yeah.
Until next time, keep exploring, keep learning, and most importantly, keep diving deep into the world of investing.